in the 2000s, silver and gold did well also when US equities recovered in a bear market rally. So once, let's say, gold breaks, SPX breaks down versus inflation or versus gold, when there were bear market rallies for SPX, silver and gold did very well and they outperformed. So what I'm looking at is when the US equities rally, so let's say those portfolios, those 60-40 portfolios going up, that's fine. But I want to see gold and silver outperform. So I want to see them outperform like that. In the 2000s, that's pretty much how it behaved. But I noticed in the 70s that there were periods where gold and silver, they went up with US equities when US equities bear market rallied and they outperformed them. But there was periods also where US equities completely tanked and they did not drag gold and silver down, and gold and silver went up. So look, yeah, those are scenarios there we're looking at, but it's look, when you look at these long-term cycles, it's just we have to awaken folks to they got to get out of their daily charts, right? And a book like that, what I like is you have evidence from a whole spectrum. Yeah, you have the fundamentals, you have the history, you have charts. It's like you really went through everything you could grab on to get evidence for or against, and you compiled everything together and you tried to explain it so folks could understand. The moving average of silver, a long-term moving average, let's say 7-year or 8-year moving average, has always been going up inversely to the destruction of your purchasing power, just like gold. So if people are lucky or they know classical chart trading, they're able to buy silver when they know it's historically below the mean, starting to outperform, and not buy when your grandma tells you to buy it because it's tripled already. It's at a spike. That's not. It's almost a disservice. Yes, silver is good, but you don't want people buying at a parabolic melt up top, right? You want them buying when it starts turning up. But the moving average for silver, you're right, it's been increasing. It used to be 25 cents. It used to be $4, $8, and now the moving average, I don't know where it is. Like you said, $18, $20, depending which one you're looking at. But it's been gradually going up. And so, yeah, it's important to look more at the moving average for silver and see where the price is in relation to that. Gold, if let's say there's debt destruction and the purchasing power of the US dollar actually goes up, let's say they decide to be responsible. Well, of course, gold value is going to go down because the US dollar strength, let's say it's going up. So the price of what I thought, instead of gold going to 5,000, well, it could stay the same or go down to 800. If they destroy all the debt, there's less slosh of money. So for me, sometimes, but everybody says, Patrick, they have to print, the whole system's going to implode. Well, I'm just wondering, what if they let it implode? And of course, gold value is going to go down. So for me, that's always in my back mind. Let's say they do let it, like in the Great Depression, it's like there was total deflation. We're not telling people to buy, like us as technical traders. We're going for but see, it's not when we have laser eyes. That guys, the laser eye stuff, it's like the biggest telltale sign you're close to some type of top. It's like we have nothing of this. People throw rocks on us when we talk about silver and gold. They throw rocks. The fact that we're not popular, we're not on CNBC, should tell everybody, ding, 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 ding. Don't listen to the guy who made $10,000% profits. That run's done, guys. It's done. The guy who buy Bitcoin at $1 and sold at 65, that move is cooked. It's done. You have to look at the next asset that's going to do 10 bagger, I'm not a financial planner, so everybody has got to do what they have to do.
Exactly.
But from the big picture charts, the way I see things going is inflation, destruction of purchasing power is the recipe. That's what's happening.
Right.
And it's going to be monumental, the breakdown in destruction of purchasing power. I have a chart. I have a chart. The destruction of purchasing power now, the rate of change is accelerating to levels last seen in the 1970s.
Absolutely.
It's like you need stuff that's real, guys. You drop on your foot, it's real. So even if the purchasing power goes up or down, that thing that's real, it stays real. It's worth whatever it's worth. If your fiat's worth less, then that thing's going to cost more. If your fiat's worth more, that thing's going to cost less. But you need stuff that's real right now. You cannot do price to earnings ratios, forward looking 30 years to break even the company. That stuff makes no sense to me now. Sorry for the emotional thing, but it's happening, guys, in front of us.
Exactly. I mean, one of the charts I was looking at yesterday was inflation. I think I have one in the book, but there's another one that has It's inflation in the 70s. Another chart has the same chart has overlaid on that is unemployment. And so I'm saying this as maybe a little bit of a warning, to anybody who's watching, because in the 70s, the inflation came in three waves. So you kind of, I guess, late 60s, early 70s, and then mid 70s, and then finally at the end of the 70s. But later on top of that was the unemployment rate. And the unemployment rate actually, as inflation tends, because we have these waves, as inflation peaked in a wave, unemployment tended to bottom slightly before. So I'm saying this because if people are, arguably, I think right now might have just seen a bit of a peak in inflation. And part of the reason is if you look at things like the base effect. So we're always looking 12 months back. We say, okay, what's the inflation rate today? We always look at it over the last 12 months. Well, it's been really high. 12 months ago, it really started to climb. And so if it's easier for the monthly rate now, going back each time over 12 months, to look over, let's say, last November or last October. And for us to see a peak now, and have the base effect say, well, it's slightly down from 12 months ago, or it's flat from 12 months ago, people will start to get the feeling that, oh, this is done now. I don't need to worry anymore. Inflation's behind us. Central banks waved their wand and they fixed everything, and everybody's happy. But again, if you look at that chart of the 70s, that is not what happened.
It's like they pushed it, and the reactions, the lags, and then it's like they overcorrected.
Exactly.
It's your waves that you explain. It's gonna take some crazy excess in one direction. Look, until people say death of U.S. equities, like then there's no top in precious metals at all,
Exactly.
at all. So
Agreed.
we're good, guys. It's just. It's these waves, like they come in threes, ripple sine waves that get just amplitude until they start to unwind. We're just starting. This is the first wave, the first, and that thing's going to reverberate in more craziness. It's going to be insane what's around the corner. Like, I don't know. People think I'm happy about this. I'm not happy, but I'm prepared, so I'm able to talk about it. But people, you can't do the ostrich, guys. You cannot do that. That's what your book's bringing out. Our charts. It's people cannot do the ostrich anymore and just following that guy at the bank who says that guy does not know the word sell. The guy at the bank, he does not know. He's a financial advisor for real. He's certified. I'm not. And they don't know how to say, guys, well, maybe you should be holding more commodities. Maybe you should be more cash. They don't know that word. And everything invested 100% of the time.